Welcome, fellow 401k investors. Thank you for joining us. Wherever you're listening from, we want to give you a glimpse today into current market conditions and address the critical questions that always come up whenever markets are down. Some of the figures we're going to use and dates will be specific to what is happening right now. However, the tools we want to teach to help you make the best of this bear market can also be used when our 401k balances start rising again, and they will. And so we encourage you to revisit and apply the principles from this presentation throughout your entire career and into retirement as well. Now, after one of the most remarkable runs in modern history, the stock market has finally paused to catch its breath. Bear markets like the one we are in now can be scary. We know this. But they're also normal and quite necessary. Consider something John Bogle, founder of Vanguard Funds, once said, quote, "When there's a gap between perception and reality, it is only a matter of time until it's reconciled in favor of reality." The reality is that even without a major war, global pandemic, or high inflation, stocks, at least in some sectors, had already begun to climb too high. Not that those factors are not major drags on the world's economy. They absolutely are. But the truth is that at the end of the day, all of the economic adversity in the world won't necessarily bring a bull market to its knees unless it's already been fueled by good old-fashioned euphoria. In our case, think meme stocks, cryptocurrency, or an overheated housing market, just to mention a few. Now, think about something John Templeton, founder of Templeton Funds, once observed about rising stock markets. He said this, quote, "Bull markets are actually born on pessimism. They grow on skepticism, they mature on optimism, and they die, you guessed it, on euphoria." What this tells us is that it's actually human nature that can push a bull market too high and ultimately lead to its demise. But more importantly, and for our peace of mind today, what Templeton left us with is this singular and timeless truth. The economy doesn't have to look better for the next bull market to begin. Now, Vin Scully, beloved voice of the Dodgers, said that when he began his baseball broadcasting career, at that time for the Brooklyn Dodgers, he observed that he was losing listeners after just a few minutes, sometimes a few seconds. And what he discovered was until he answered the most important questions, and then two others, on his listeners' minds, they weren't able to hear really anything else he had to say. The question, you can guess, is the same one on all of our minds when we tune into our favorite sporting event. What's the score? And once he answered that question, then they wanted to know who's winning. And if my team or my athlete is behind, by how much, so we know what we need to do to make up ground. And what he found was that if he began to weave the score into every sentence or two, then he was able to hold his listeners' attention and began to tell the story of the baseball game he wanted to tell. There are three critical questions that come to investors' minds every time we go through a bear market, which is, by the way, a market that is either by general definition declining over time without a major upswing, or a little more widely accepted semi-technical definition is a market that has fallen at least 20% from previous peaks. And so the questions that come up when we're in a scenario that's as scary as the one we have been in since about January of this year is, how bad are things right now? And more importantly, how low could the market go in my 401k balance before it begins to recover? And how long might this last? So just how bad are things right now? Well, between Russia's war on Ukraine and the Fed's war on inflation, plus Elon's war on Twitter, and not to mention a lingering pandemic and the mind-boggling price of a house in Boise, we'll admit things do look pretty bad. It's at moments like these that we like to gather around the office, take a quick time out from the flurry of phone calls and the avalanche of bad news, and we like to remind ourselves of another timeless Templeton truth. Sir John once said, "The four most expensive words in the English language are, 'This time is different.'" Close quote. And then we like to ask ourselves two questions. First question, has any of this happened in the past? In other words, is this time truly different to the degree that our investments will never recover again and we won't ever be able to retire? That leads to the second question, which is this. If any of this has happened before, did we find a way to work through it? What we've discovered is that if we can answer yes to both those questions, we know that everything will be all right in the end. To quote another movie, the best exotic marigold hotel. The hotel manager, Patel, is standing behind the front desk, and one of the guests is bemoaning the fact that everything that can go wrong has gone wrong. To which Patel reassuringly responds, "Don't worry, everything will be all right in the end." And if everything is not all right, it just means it's not the end. So we want to go down the list here with you and let you be the judge. Have we ever seen a major war in the world before? The answer to that one is easy. Of course we have. What about a global pandemic that impacted economic activity to the scale this pandemic has? We have seen several pandemics in the past as well. What about an overheated housing market or high inflation environment? Have we seen those items before in the past? The answer to the first question, has any of this happened before, is a resounding all of this has happened before. Leads us to the second question. Did we find a way to work through those things every single instance in the past and get to watch the world's economy, US stock markets, and our 401k balances grow again? The answer is yes, yes, and yes. Now, if you're still unconvinced and feel like the sky truly is falling this time, I like to quote another favorite movie of mine, Blood Diamond. There's a scene that always comes to mind. This is a movie that's set in South Africa during the Clinton and Conflict Diamond era. And there's a particular moment at an outdoor bar where Jennifer Connelly, playing a truth-seeking journalist, Maddie Bowen, is standing watching a television playing CNN above her head. And they happen to be broadcasting the latest Clinton scandal. And she turns to Leonardo DiCaprio, who is playing the steely-eyed soldier of fortune. And she says, quote, "Are you listening to this? The world is falling apart. And all we get to hear about is Monica Gate." To which leading man Leo responds cleverly, calmly, truthfully, "Well, tell me, when was the last time the world wasn't falling apart?" Now, for me, this always brings things back into perspective. And it adds new meaning to the old Wall Street adage, the Dow climbs a wall of worry. We know that we will get through this. It feels like we're losing right now, but it will not last forever. And in the meantime, let's check out what the actual score is. Since the beginning of this year, the market is down about 25%. Now, this is through the end of September. We actually had a pretty good day earlier this week, went way up, a little back down again. We're hovering right around 22 to 23% negative returns from January 2022 until now. The S&P 500, by the way, is a pretty broad representation of the stock market. Some people prefer to quote the Dow Jones, others other indices. This is generally the tone and the tenor of what's happening right now. This is the score. This is how far we are behind. You've seen this as you've logged into your 401k accounts. Now, on the initial slide, we showed you a line, perspective can equal patience. I'd like to give us a little bit of perspective before we zero in on just the last 8 or 9 months and take a look at what has happened since the last bear market that we were in. No, not talking about the bear market that happened in the beginning of the pandemic. If we recall, around early spring 2020, The Dow Jones dropped 38% just over a few weeks time. Some refer to that more a blip than a bear. Remember, we've talked about a bear market that drops more than 20% from previous peak. So that clearly met the definition technically of a bear market, but it was so quick and so fast the recovery that by the end of summer we saw the market hitting all-time highs. Now I want to go back further than that to when Barack Obama was in office. This is a while ago, and the World Health Organization had just declared the swine flu, H1N1, remember that? A global pandemic. That's sort of ironic. What else was happening? Sully had landed his plane on the Hudson around the time of the last bear market, and our high school seniors were in diapers. That's how far back you have to go to find a period of time in the market similar, in fact, in some ways, even more serious than what we are in now. We had seen declines that actually exceeded 50% by the time that bear market ended. But look what happened since. The perspective that hopefully this can give all of us, affording us patience in this current bear market, is to understand that from the last bear market, even to the one we're in now, markets grew over 500%. And so I think you'll probably agree with me when we would gladly give the market back 25%. We owe it that for a 500% return any day. If you're thinking right now, I appreciate that. I like the 500% return, but an even more serious question might be the second one. How low could the market go before this is over? And by the way, what if I lose my entire investment value in my 401k account in the meantime? I'd like to address that second question first. When you make a contribution to your 401k and the employer match is added to that and it's deposited into your account, that money doesn't just stay there idle. It's actually put to work right away. And you've seen when you've logged in your account balance, the actual money value. But if you've taken a moment, or if you can, the next time you log in, I'd like you to actually pay attention to the quantity of shares that you've accumulated over your career in whichever portfolio you happen to be using. Those shares represent ownership in quality companies. And so each unit or share that you have purchased is actually then representing ownership investment in companies like Walmart and Walt Disney, Amazon and Apple, Microsoft and McDonald's, quality corporations that do grow over time. Once in a while, you'll see a company go under, but these are hundreds of companies that you're investing in through those funds in your 401k account, and you have earned all of those shares by contributing through up markets and down markets over time. Now, what would it take for you to lose then your entire account value? Well, every single one of those companies would have to go under. They would have to declare liquidation, bankruptcy. They would have to go bankrupt on the same day. That's the kind of scenario that we're talking about, sort of an apocalyptic situation for your value to actually go to zero. So if we can remove that one from the conversation, take that off the table, and more talk about what have markets done in the past? What can we typically expect based on past performance? We know that doesn't predict future results. The windshield is always a little foggier than the rear view. But I think we can get a little bit of context by looking at some of these bear markets since the Second World War. We've had 14 of those, and the average decline from peak to trough in bear markets since the Second World War, when coupled with a recession, was right around 35%. Now, when no recession materialized, the drop was a little bit less, around 24%. We've seen the score, we're down about the equivalent of that right now. Now, wouldn't it be wonderful if we could declare today with a crystal ball, no official recession will be reported by the Fed, and this 25% decline we've seen is the bottom, and we're going to grow from here. We have no idea. That's the honest answer. How low this particular bear market will go before we hit bottom. We don't even know if we're officially in a recession yet. All of the warning signs are there, And by the way, to remind you, the definition is generally 2 consecutive quarters of negative GDP. That's what the Fed uses, along with some other factors, to officially declare a recession. Unfortunately, we don't learn about those until we're already in the middle of them. I'd like to make a comment here. If the Fed does report a recession, does that mean that the market has to go down more? Does it have to decline 35, 45, 55% or more? Not necessarily. It absolutely could, and we probably will see some more declines. At least we know a lot more volatility before we get through this. However, remember this. Financial markets don't always decline because of recession. They decline in anticipation of one. And so hopefully at least some of that negativity bias is already built in. This leads us to the third and final question on our short list. How long could this bear market last? We understand that this is of particular importance to those of you who are on the cusp or already retired, especially if you're in a situation where you'll be spending income from your account within the next several years. This is an extremely important question to address. So let's see what we can learn from history. Since the Second World War, we've seen 14 of these bear markets now. The shortest one we discussed already occurred right at the outset of the pandemic. The steepness and the sharpness and the quickness of the decline was frightening. The velocity of the recovery was even more amazing. Now, the economic headwinds we're facing right now will probably take a little bit longer to work through. We don't know how long this present bear market will last. Let's be clear, we don't have a crystal ball. However, historically, I think it's important to know that the longest in modern history we've seen was back in the early 70s. That bear market only lasted about a year and a half. So hopefully this can afford all of us a little bit of perspective that can give us patience while we are waiting for this bear market to end. There's also some things that you can do to protect your investment and be prepared for the next bull market that will come. Here's where we get to the really good part. We'd like to equip you with both some defensive and offensive tools that you can use to make the very best of the bear market that we're in for as long as it lasts. The tools we teach here could be summarized in 2 words. You can probably guess what those are. It's the same mantra that we march out every time markets decline. Those words are stay invested. And that'll be the overarching message here, but we want to dig a little deeper and give you 5 reasons why you should never flee a falling stock market. Just like you're not supposed to run from bear in the woods, in this case, for investors, it can be financially fatal. Let me explain what I mean by fleeing a falling stock market. There's typically 3 ways that that's done. Either you move into the money market fund, which is an option in our plan, but while it is, keep in mind that if you do that, you're going to be selling all of your shares, turning temporary declines into permanent losses. The other way you can do that is to actually roll out or withdraw your money from the account with the same result. You're going to be selling all those shares. And the third way to do that, it's a little extreme, but we saw this from time to time during the extreme declines of the Great Recession when 401k investors actually stopped contributing. Absolutely never recommend you do that for investment reasons. Number one, you're going to lose out on the opportunity to purchase shares at current lower prices. Stocks are on sale. And the other reason, of course, is pretty obvious. You lose your employer match. Now, the first reason not to do that is that historically, after steep declines, stocks tend to snap back quickly. Now, that doesn't necessarily last. Like we saw since June, we had a nice rapid recovery, but then we're back down again. We understand that. But the recovery will come when you least suspect it. Stocks can turn a corner pretty quickly, and it can surprise, and usually does, all of us. And so the lesson to be learned here is, if you've asked yourself, and this question comes to us all of the time, especially again, if you're in those late stages of your career or retired, well, I think the market's going lower, so what if I just get out for a while? What if I just move into that money market fund you talked about, and then I'll get back in when things are better? Here's typically how that goes. If you've moved your money out of the market, and you're waiting for a happy headline on CNBC, or a rosier report from the Fed, and then you get back in, you've missed the bulk of the recovery. Warren Buffett puts it this way: if you wait for the robins to sing, spring is over. Most of our participants we see will stay invested for at least that month. If you'll stick around, imagine what can happen later. Historically, the average return across those bear markets we've discussed was a positive almost 6% just 3 months later. Now, if you're willing to be like the man in that old classic movie, The Man Who Came to Dinner, move in, keep your money in the market, stick around for a while, just 1 year later, the average return almost 24%. Now, the third reason to remember that mantra, stay invested while markets are down, is the simple fact that across at least modern history, bull markets outlive bear markets about 3 to 1. Now, while this hopefully can give us a little more patience right now while we are all experiencing these declines in our 401ks, if we do this next part right, you might actually want this bear market to last a little bit longer. The reason you might like this market to last a little bit longer, especially of course if you are an active employee contributing, is that bear markets will deliver your biggest returns across your career. Let me show you an example of how this works. If you take a $600 example and invest that in a $10 fund, and these are the share prices that are right around where some of our fund shares are right now, about $10. And if you take a simple example and say over 6 months' time, that $10 share is going to increase in value to 20. And you would think, and rightly so, without any other context, great, my $600 investment will double after 6 months and I'll have $1,200 to play with in retirement. That is true if you're investing everything at once. Now, that's the dream bull market scenario where stocks never decline, your 401k balance is always rising every time you look at it when you log in or open your quarterly statement. Wonderful. What about a bear market scenario? In this case, if you take an example of the $10 share dropping all the way to $1 and only recovering to half its original value, you would be correct in thinking, I'm going to have half my original investment. That's no good. But you already know that that's not how this works in 401k plans. You don't contribute a lump sum of money the first day you're hired, and then whatever that turns into when you retire, that's what you get to spend. Not how it works at all, of course. You take a small piece of your paycheck, you contribute it to your account, and what happens is that contribution plus your employer match in the event that that is available to you as it is in our plan is going to be deposited and then purchase shares at the price those investment shares are going that day. And so the bull market investor in this case is going to be buying at higher and higher prices if they experience financial markets that never pull back, never decline. And so $100 a month is going to be purchasing fewer and fewer shares as that price goes higher, meaning that $600 doesn't double at all, it only turns into $840 for the bull market investor. The bear market investor, those who stay in during market declines, is going to enjoy a $1,300 result, and here's why. Just take one example here. At $14 a share, that particular paycheck on that month, the $100 only got me a little over 7 shares. But with the market declining as it is now, $5 a share, now I got 20 shares. So the 42 shares I was able to accumulate here multiplied by $20 gives me that $840 balance. That's a great return, but wouldn't I really rather be able to accumulate this massive amount of shares over my career? And this is why it matters to keep contributing as an active employee. Now, what if you're retired? Let me speak to you for a moment. You're thinking, well, but that's not true for me. I'm at the mercy of the market. I can't contribute anymore. True. However, keep in mind that there are dividends that are paid to you if you'll hold on to your investment shares and not sell them. And by not selling them, I mean not moving out to cash or withdrawing, etc. Let me give you a real life example. Just recently had a conversation with a participant who was looking at this scenario, was already retired and saying, okay, but how do I deal with this now? I can't even dollar cost average. We looked at the transaction history in his account. And back in December of last year, when a lot of those dividends are paid, the bulk of the dividends typically are paid into our accounts, we saw a deposit of $6,000, of $1,300, of $800. All of that money he was earning from owning the shares, and those mutual funds were paying dividends. Those get redeposited for you And so you actually do get to buy a few more shares when prices are lower, even when you're retired. Now, the fifth and final reason to stay invested, every single bear market in history has been followed by a bull market. We see no reason to believe that this time will be any different. This principle is so powerful, in fact, that historically markets rise almost 80% of the time. Now, that could be motivation enough to stay invested, to make sure you're ready for the next recovery. But consider also the money to be made while markets are down. That's why it's critical to keep contributing. And if your budget allows it, without it being at the cost of something that's more important in your financial life right now, even increasing your contributions can create a real boon during a bear market where you can scoop up these shares. Stocks are on sale. They're currently 25% off. Maybe they'll go lower. We'll get the opportunity to invest in quality companies at even better prices. Now, if you're retired, it's important to stay invested because you can collect those dividends, and also those are reinvested and you get to make money while markets are down. Peter Lynch illustrated this perfectly when he made this point. He managed the Magellan Fund at Fidelity and over 13 years achieved what no professional manager had before or has since, a 29% annualized return over that remarkable run. He said that was not what was the most fantastic fact about his time managing that fund. He said, quote, we were consistent. The market was down 9 times over 13 years. He said our Magellan Fund was down 9 times over 13 years. The market went down, we never got out of the market. Stay invested. It's the safest course. Don't worry so much about this bear. He's only clearing a path for the next bull. Thank you